Hello, I'm Pete Nicholson. I'm the Chief Fiduciary Officer with First National Wealth Management. Today, we're going to talk about today's fixed income environment, the role that fixed income plays in a portfolio, as well as how to structure a portfolio given today's interest rate environment. Today's environment with interest rates and fixed income is certainly interesting. We started the year off with a 10-year Treasury rate around 3.8%. Now we're close to 4.7% on the US 10-year Treasury. So it's been quite an exciting environment. And really, there are a couple reasons for that. Number one, the United States growth continues to be strong. And number two, when you look at the expectations for the Federal Reserve and what they're trying to combat, they're trying to combat heightened inflation. And the inflation numbers have been a little higher than expected. Yesterday's consumer price expenditures were a little higher than expected, at around 3.7%, higher than what was expected, around 3.4%. So as a result, the expectation for Federal Reserve rate cuts have been pushed out into the fourth quarter of this year. So when you look at interest rates have moved higher, existing bond prices have fallen, as well as stock prices over the month of April. Fixed income is still relevant today. You have to really think about fixed income as serving as the ballast for the portfolio. When the stock market is down or is choppy, fixed income really is meant to be a diversifier in the portfolio and still serves as ballast. So meaning that when the stock market's choppy, fixed income is meant to continue to pay a bond investor interest and coupon payments along the way. There are periods of time in which the stock market and bond market move in tandem. And this happened a few years ago when rates moved higher and the stock market fell. And as a result, bond prices fell. So you really have to avoid looking at fixed income myopically, because there will be periods of time like April when fixed income prices will depreciate. But the idea, again, with fixed income is that you as a bond investor, you're most concerned with continuing to receive coupon payments from fixed income along the way. And if you're investing in individual bonds, individual treasuries, individual CDs, the idea is that you're going to continue to receive interest payments along the way, and in addition to your principal back at the end of the term. So no matter what happens with interest rates, you're most focused on receiving those coupon payments at the end of the term, as well as your principal payments. Today's fixed income or bond sweet spots are really in the corporate bond curve, the corporate bond area of the market. If you look at high quality bonds today, kind of in that sweet spot of the curve, it's 5 to 7 years. So you don't want to think about bonds in terms of price depreciation or price appreciation, but given the expectation for Federal Reserve and what we believe they're going to do into perhaps Q4 of this year, the intent is to drop interest rates. And right now there's the best value or the best component of the curve in which to invest. You want to make sure you're locking in some higher yields right now, because if the expectation is for yields to drop further down the road, then you want to try to lock in some of those yields today. And you can do that in the corporate bond space by investing in high quality fixed income. You can also lock in some of the attractive CD rates that are out there today amongst banks. And you should really think about both short-term and long-term. You don't want to be focused on one end or the other. You really want to have a combination of both. You want to be nimble enough where you don't want to expose your portfolio enough to heightened duration or sensitivity and interest rate risks. You want to invest short-term, but you also want to be able to capitalize on some of the return potential today by investing in longer-dated fixed income positions. Duration is a measure of interest rate sensitivity in a bond portfolio. So the higher duration you have, the more interest rate sensitivity you have in a portfolio. Whenever the Federal Reserve influences interest rates on the upside or the downside, you're going to see some price movement in fixed income. But you don't want a long enough duration where you're going to see considerable fluctuation in the portfolio. Should the Fed decide to raise rates? We're actually at a point now where we expect the Fed to drop rates, although the number of rate drops are going to be a little less than what was expected coming into 2024. But we do want to balance that risk out. We want to be long enough where we're capitalizing on the current interest rate, where current interest rates are today, but we don't want to be long enough where we're increasing that sensitivity to interest rate risk. We are kind of taking what we call a barbell approach. We're keeping some short term, capitalizing on the high short-term rates, but also locking in some rates on the longer end as well. We do have to remember that we are still in an inverted yield curve environment. On the treasury yield curve and the corporate bond yield curve, although the curves are not identical, they're still inverted, meaning that a lot of the short-term rates we're seeing today are higher than some of the long-term rates. But you want to be able to capitalize on both. You want to have a little bit of short-term, but you also want to lock in longer-term, because especially as the Fed looks to drop rates down longer term, inflation expectations will continue to fall, and that means you're going to be able to capitalize on some of the price appreciation potential on the long-term end of the curve. Bonds are still relevant today for a couple different reasons. If you look at interest rates today and where they are and the actual returns you're getting from bonds today, they're still higher than they were this time 2 years ago. So bonds still serve as a means of generating income in a portfolio. But in addition to return potential, generating income from fixed income, they still serve as a means of ballast in the portfolio and diversity. So when things do drop, when asset prices drop in the stock market, bonds are there to help preserve the portfolio or to keep you rich. Stocks will get you rich, as they say, and bonds will keep you preserved and keep you that way. So they still do serve a very important purpose in the portfolio, and you can do it a number of different ways. You can invest in individual bonds. A lot of people are comfortable with investing in individual bonds. And you can also invest in mutual funds as well. Today, bond fund managers are very optimistic about the returns you're seeing in the bond market because yields have heightened. So you can take advantage of that, but still stay marketable by investing in a bond fund if you need to sell it. Although you're going to be better off holding a position longer term. But if you do need to sell a bond mutual fund, you can do it.